Brad Williams, Frugal Finance, retitling assets when a spouse requires Medicaid for nursing home care. When one spouse requires long-term nursing home care that Medicaid will cover, or if they need home care services through Medicaid, transferring certain assets into the spouse's name can be a wise decision. If you or your spouse are facing the need for Medicaid-funded long-term care, you might consider retitling some assets to prepare for Medicaid eligibility. Retitling can also be a helpful step even after Medicaid benefits have begun. Medicaid does not penalize gifts made to a spouse or to disabled or minor children, meaning such transfers won't trigger a period of ineligibility during Medicaid's 5-year look-back period. This offers an opportunity to preserve assets for your family. This article outlines when and how you can retitle assets like your home, life insurance policies, and retirement accounts. Why a spouse might retitle assets for Medicaid eligibility. Medicaid is a needs-based program, meaning there are strict asset limits for applicants and their spouses. An applicant needing nursing home care or home and community-based services can usually keep between $1,500 and $2,000 in assets after qualifying for Medicaid. However, the healthy spouse, known as the community spouse, is allowed to retain a much higher amount to cover future living expenses. This is known as the community spouse resource allowance. Retitling assets, such as life insurance or the title to your home, can help keep the Medicaid applicant's assets below the limit set by Medicaid's regulations. Additionally, transferring the deed of the home can help maintain eligibility should the community spouse pass away, which could potentially affect asset limits. Whether you already applied for Medicaid or are in the process of doing so, transferring assets to a spouse is allowed without penalty. The sooner these changes are made, the better, as it can prevent complications in the future. Retitling assets to avoid issues if the applicant becomes incapacitated. In some cases, the Medicaid applicant may become incapacitated and unable to make decisions about transferring assets. Once the applicant loses the mental capacity to manage their affairs, a power of attorney is required to handle transfers. However, in many cases, a power of attorney doesn't authorize transferring assets to the community spouse if the spouse is the designated agent. Alternatively, court-appointed guardian or conservator can make asset transfers, but this process is expensive and can take considerable time. If the Medicaid applicant is still mentally sound, it is easier to transfer assets now. Doing so ensures that in the future, the community spouse can manage and transfer assets as needed for Medicaid eligibility. Medicaid and home ownership. When transferring the home title makes sense, typically married couples own their homes jointly unless the property was previously owned by one spouse or was inherited. If the home is jointly owned, transferring the title to the community spouse may be beneficial. Medicaid usually doesn't count a primary residence as an asset if the community spouse continues living there, unless the house has significant equity. However, there are important reasons why transferring the home's title to the community spouse may be necessary. If the Medicaid applicant becomes incapacitated, transferring or selling the home can become difficult. Moreover, if the house is owned jointly with rights of survivorship, the community spouse's death could result in the home being considered part of the Medicaid applicant's estate, potentially disqualifying them from Medicaid eligibility. One of the main benefits of transferring the home title to the community spouse is that it prevents Medicaid from placing a lien on the property for estate recovery after the Medicaid recipient passes away. Medicaid can reclaim funds spent on care by forcing the sale of assets in many states. By transferring the title to the community spouse, the home will no longer be part of the Medicaid recipient's estate, safeguarding it from estate recovery. Transferring life insurance for Medicaid. For Medicaid purposes, only whole life insurance policies are counted as assets. Term life insurance does not accumulate cash value, so it is not considered accountable assets. While some states exempt small whole life insurance policies from being counted, others limit this exemption to policies with death benefits of $1,500 or less. Larger policies may be counted based on their cash surrender value. One option is to transfer ownership of life insurance policies to the community spouse. This transfer won't disqualify the Medicaid applicant since transfers between spouses are permitted. The community spouse then benefits from the cash value of the policy, which counts towards their resource allowance. However, the Medicaid applicant would lose the death benefit. lose the death benefit unless they liquidated the policy. Alternatively, the policy could be transferred to a disabled or minor child, though this would be considered a gift if the child is an adult without a disability, triggering the 5-year look-back rule and creating a potential period of ineligibility. Retirement accounts and Medicaid eligibility. Retirement assets can present significant challenges when qualifying for Medicaid. Medicaid considers retirement plans such as 401ks and IRAs as countable assets, and these cannot simply be transferred to the spouse. One option for Medicaid applicants is to cash out the retirement plan and use the funds to purchase a Medicaid-compliant annuity for the community spouse. This annuity would provide income for the community spouse, but wouldn't count against the Medicaid applicant's eligibility. Alternatively, the retirement account could be annuitized, turning it into a stream of income based on the account holder's life expectancy. However, income from this annuity would count as income for the Medicaid applicant and could affect their Medicaid eligibility. Some states, including Florida, Georgia, New York, and Texas, do not count retirement accounts as assets for Medicaid eligibility if the account is in payout status. In such cases, required minimum distributions from retirement accounts would not count as assets, but they may still count as income. Handling the spouse's retirement accounts. In some states, the community spouse's retirement account may be counted as an asset in determining Medicaid eligibility. However, in states that do not count a spouse's retirement account, accounts may be in payoff status to be exempt from. However, in states that do not count a spouse's retirement accounts must be in payout status to be exempt from asset limits. If a state counts the community spouse's retirement account, they may annuitize the account, converting it into an income stream, thereby making it exempt from being considered an asset. Community spouses may also want to update beneficiary designations on their retirement accounts. If the Medicaid recipient is still the beneficiary and the community spouse passes away, the Medicaid recipient could inherit the account, causing them to exceed the asset limits and lose Medicaid eligibility. To avoid this, the community spouse could change the beneficiary designation to someone other than the Medicaid recipient. Conclusion: retitling assets can be an essential step of preparing for Medicaid eligibility when one spouse requires nursing home care. Transferring property, life insurance policies, and retirement accounts can help ensure that assets are protected, Medicaid eligibility is maintained, and the community spouse has the financial resources to manage living expenses. It is highly recommended to consult with an elder law attorney to ensure compliance with state-specific rules and regulations when considering these options. Comment if you have any questions relating to retitling assets. Brad Williams, Frugal Finance. Thanks for watching. Hope that helped. See you soon.